Holy smokes, Wall Street banks are now actively calling for stimulus checks. I'm gonna show you this Wall Street piece right now, but this is wild. I haven't seen this, and it's frankly a sign that I think a lot of banks are starting to freak out, and a lot of people on Wall Street are tired of winning. Are tired of losing. Markets in the last 31 hours have lost $5.4 trillion. The largest drops in the S&P 500, the Dow, the Nasdaq since March 16th of 2020. We were 79 bips away, that's close, from a circuit breaker going off on the stock exchanges. Imagine the cover on the Saturday newspapers had the circuit breakers gone off. Stocks drop so badly, they have to close the stock exchanges. That's not good. It just breeds more panic. JP Morgan now said, 60% chance of recession. Oh, no, scratch that. JP Morgan now expects a recession in the third or fourth quarter. And remember, folks, in this day and age, markets and news move a lot faster today than they did in 2001. In fact, the 2020 crash, remember when I sold and went to cash in January of 2022, sold and went to cash. I'm like, I don't know, let's hold on a second. Ended up launching companies later that year, close to the bottom of the market, both HouseHack and a fund, which performed excellently. The total flows, we have seen flows in 2022 move 3 times faster than they did in 2001. Now, what does that mean? Well, 2001 was a 3-year crash. 2022, we saw it all in 9 months. What could that mean for today? Well, a lot of this compression that we're getting in pain could be just that. Things are just moving a lot faster today than they have historically. And if we're truly getting ready to price in recession, pricing in that recession could happen a lot faster than we think. This is why some are now calling the Mag 7 the Sag 7, but eventually there's going to be a buying opportunity. Now, what we'll do is we'll also look into some opportunities for when it's the right time to buy. But it's worth noting, in the meantime, as we get into this stimulus check item here, take a look at this. You've got Rabobank now actively asking you, have you said thank you once? This is a pretty big, important question here, because now you've got researchers making fun of the J.D. Vance Oval Office event. It's gotten to that level of fear. I didn't think it could get much worse than that. And then I saw the stimulus check level of fear. Let's take a look at that. Quick mention, I'm seeing a lot of this happen as well. I personally see it as a bit of an indicator, but I'm seeing a lot of emails like this. Additional investment, $60,000 investment added, wire transfer completed. A lot of emails like this about HouseHack, my real estate startup where people are able to invest even if they're non-accredited investors. Go to househack.com, see the financials. You get 100% of the company upside, downside protections. So if we 5x, 10x, 20x, 100x, 2x, hope whatever it is, obviously hope the best, you get that upside, you have downside protection, and you get a 5% yield. Go check it out at househack.com. But what's awesome in the scary use of the phrase right now for some, and in the exciting use of the word awesome for others, is Deutsche Bank. Deutsche Bank now actively suggesting we should be sending stimulus checks because the market is going poopy doopies. What stops this? The market is doing one thing, pricing in a global recession. That's what the market's doing, which, by the way, could be one of the reasons you're seeing such positivity in Bitcoin, frankly. Bitcoin doesn't have earnings per share. There are no margins to compress. You know, the CEO of Restoration Hardware is on Jim Cramer's show right now talking about how our margins aren't compressing because we have all this inventory to go through. Yeah, well, this morning in the course member live stream, we went through their inventory and we see that they have $30 million of cash, over $1 billion of inventory, and we're like, how long is this gonna last? 2 to 4 months, best case scenario. So they don't actually have that much inventory. They got just enough to maybe get through some of this negotiation phase of tariffs. They do not have enough to get through sustained tariffs. Could create opportunities, though. Always opportunity in crisis. Just have to know where to look. Anyway, going to this Deutsche Bank piece. This is the shocking piece. Market is doing one thing, pricing in global recession. What is the circuit breaker here? Well, it's not going to be central banks. Instead, they say it's going to be fiscal policy. Okay, in plain English, that means stimmies, but not I'm not interpreting this. I'm going to show you where they say it. You ready for this? I don't want you to think it's Kevin's just like stretching this out or whatever. They say it. You ready for this? In the United States, the administration needs to re-anchor the debate around fiscal strategy that offsets the huge tax rise that's about to take place because of tariffs. We noted yesterday that Treasury Secretary Bessent refused to do this following the trade announcements on the 2nd, on Liberation Day. You ready for this? Okay, this is the moment. This is where they say it. This is not Kevin like trying to stretch some interpretation here. This is a Wall Street institutional research document. And what do they tell you should be done? It's right here, folks. Examples of re-anchoring the fiscal debate include providing paychecks to households who are hardest hit from the tariff shock and introducing retroactive cuts this year, tax cuts, in the reconciliation bill that is currently being formulated. In other words, you literally have Deutsche Bank research now actively calling for paychecks to be sent by Americans affected by this tariff drama because it's been 2 days of a panic sell-off after the announcement, and Deutsche Bank is already freaking out. Now, Bank of America has a little bit of insight into when they think they would start considering to buy the dip. One of the tools that they're using is they're looking at the put-call ratio, and an argument that they make is they say, hey, look, you know, the put-call ratio, number of people buying puts or the number of puts being bought versus calls, so bearish bets versus bullish bets, is still below 1. It's about a 0.94. It's been skyrocketing. A place you could see this is you could just Google CNN, greed and fear. This is where people who don't understand what that is but what? You mentioned CNN? Dislike! Unsub! Anyway, take a look right here. This is the CNN Greed and Fear Index, and what you want to pay attention to is right here, this put-call ratio. You can see it's rising towards 1. Now, they only go back to about the summer of last year, so you actually don't see that this can go substantially higher than 1.0. This is not like it goes to 1.0 and then it's done. Bank of America says you want to go contrarianly bullish when this gets to about 1.3. So in other words, when you have about 30% more puts than you have calls being bought. And we're not quite there yet. In addition to this, Bank of America is telling us most people did not position for recession. In fact, take a look at this right here. Bank of America saying on January 1st, everyone was all in on U.S. exceptionalism. Few positioned for recession. I did. But then again, we've been talking about it for quite a while here because the underlying oil spillage that we've been seeing in the market has been problematic. Well, I should say in the economy, not so much the market. The market had its phase of euphoria, which is a typical way you end a Nike swoosh recovery. So we had our Nike swoosh recovery from 2022 through 24, and we ended up with a euphoric boom at the end, and Warren Buffett sold in February. He timed that top a little bit better. Good for him. But the problems of the underlying economy are present. The slowdown in the labor market, the slowdown in pricing power and growth is either going to signal a big slowdown for the US economy or something worse. Now, I call that spilled fuel. It's baggage, basically, that we have. Donald Trump's trade war might just light the match and sort of ignite that recession and bring it forward, make it happen a little bit sooner. Not ideal, and obviously it's not a foregone conclusion yet. Like we said, Deutsche Bank tells us, hey, we can avoid this. In fact, we'll go back to this Bank of America, or sorry, the Deutsche Bank piece right now. Take a look at this. Bank of America says that you could front-load tax cuts in Europe and in the United States. You could provide subsidies on consumption purchases. Republican leadership needs to provide a greater sense of urgency in moving these tax cuts along and sending paychecks to households. In other words, urgently send paychecks to households. That's what they're saying here. You know, this is... Look, we got a lot to talk about. Tomorrow we'll be live again in the course member live stream. If you're not part of that, it's a very, inexpensive monthly membership. You get access to everything that I do. It's less than about $1.70 a day. It's really good. You cancel at any time. If you've never tried it before, give it a shot. Try it out. Go to meetkevin.com. Join the course member group. We'll be talking about this. But what you're finding is that China is already doing this. China is already stimulating like this, and they're doing this because they're coming out of a recession. They're coming out of a consumer depression. Consumers have been so depressed that now China is thinking about sending tax credits to people to upgrade their phones or their computers just to get people spending. And that usually, unfortunately, government is slower than central banks. And unfortunately, the market is likely to struggle with this slower time frame. But at the end of the day, it's simple. This is a US-centric fiscal shock driven by the Trump administration, and it's Congress, so government policy, that can unwind this. Countries that respond quickest and the most forcibly to this shock are those whose currency will be the most resilient. Right, because inflation would drive up the value of their bonds and therefore the value of their currencies. Or the reverse would be true if you don't. And on the flip side, the more the US fiscal strategy under the Trump administration lacks visibility, the more the market will punish the dollar and US assets, including the SAG 7. One last point, don't expect the reluctant Fed to support the dollar. Remember that point during the European shock crisis of 2022 when the ECB went hawkish and things collapsed, blah, 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 blah. We already know the Fed's not coming to bail us out. But I really want you to think about this for a moment. The Wall Street banks are freaking out, demanding paychecks be sent by Congress urgently. We're just on day 2. This is crazy. It's crazy to me. I mean, hey, maybe we'll get those Doge dividend checks. But my gosh, and I do think there's a chance we'll actually go to stimulus checks at some point again in the future. But I'm just going to be transparent here. I didn't think it would happen on day 2. Like, people are panicking already on day 2. Yesterday was, Jerome Powell, please, bail us out, and help us. Today, Jerome Powell's like, yeah, no, I'm going to be patient. So what does it turn into? Okay, send us stimulus checks. This is unbelievable. This, like, have we learned nothing from the first cycle? I guess not. But another thing that you'll find here from the Bank of America piece that I found was interesting was Bank of America says that, at least according to their clients, they are 61.7% exposed to stocks. This means a lot of Americans with wealth are really seeing a big hit to their wealth right now. Now, I know a lot of people are like, oh, but Kevin, if you don't sell, you haven't lost anything. All right. Something we talk about in the psychology of money is if you sell, yes, you realize a loss. It's a taxable event. But don't kid yourself. When your account goes up in value, you have access to more capital. When your account goes down in value, you have access to less capital. This idea that, oh, you didn't lose anything unless you sell, oh, you don't want to lock in your losses, that's just what brokers and fund managers say to you so that way they don't have outflows out of their funds. No broker, dealer, or fund manager wants you to sell their fund because they make fees, baby fees. Now, Bank of America does suggest that, hey, if you're sticking around for some buy signals, take a look at this. For them to get a bull-bear signal that would suggest buying, so a real level of fear, because for some reason their bull-bear scale is sitting at somewhere like a 4.8, which is kind of wild, or sorry, 4.9, which seems kind of high. But they say they'd be looking as a buy signal as a couple weeks of big equity outflows totaling $100 billion or more. That would trigger a buy sale, or a buy trigger, or 88% of global equity trading indices trading below the 250-day moving average. Currently, that level sits at 29%. So, and that buy signal would first require the HK, the Hong Kong Hang Seng Index, and the German DAX to fall to 20K. All right, here's the put-call ratio. We're at about 0.94 out of that 1.3. They've got some others here. I don't think that these are necessarily as useful, but they argue that the biggest thing would be useful, which is similar to what Deutsche Bank says, would be a pivot away from tariffs towards tax cuts and, listen to this, aggressive increases in the debt ceiling via the Congressional Budget Reconciliation Bill. Well, if you want to aggressively increase debt, you're basically screaming stimulus over here too, except you've got Deutsche Bank actively calling for paychecks to be sent to households because of tariffs. We expect the impact of tariffs will be somewhere around $2,000 to $3,000 per household per year. And Bank of America is like, please take on aggressive amounts, copious amounts of more debt, lather me up. This is a clown show. It's day 2! And these massive institutions can't handle it. Man, I don't know what the signal of this is to come, but we'll be talking a lot about it in the course member live streams. Remember, folks, go to househack.com or meetkevin.com. HouseHack if you want to look at potentially investing in HouseHack and diversify away from that stock market volatility. Getting a lot of inflows here. You get paid a monthly check, 5% per year. So just so you know how that works, if you, just to have easy math here, you invest $100,000, you're getting a 5% yield. Divided by 12, that gets you $416 per month paid to you, direct deposit, ACH, whatever you want, paid to you until conversion. And the only way you get converted to stock is if our valuation goes up. Otherwise, you get your money back. So check it out, learn about it over at househack.com. You could see what assets back our company, large apartment buildings. I mean, these are massive properties, diversified single families, properties that we've all touched and remodeled and worked on. We review everything here. We do ADU developments, you name it. But there's a lot more coming to what we're doing, and get excited about some of the announcements that we have coming for HouseHack. I cannot wait. If you have questions, email us at ir@househack.com. Thank you so much for watching, and we'll see you in the next one. Goodbye, everyone. Good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.